Alright, for today's video, I'm going to share with you some sort of a tax planning to compare what will be the result of your tax payments to the IRS if you elected to be a disregarded entity versus an S-Corp. So, between the two, we have to differentiate first. What's a disregarded entity? When you open a business and you had elected to be, rather when you indicated there that you are just the sole owner, for federal tax purposes, you will be perceived as a sole proprietor and as a disregarded entity. All right. So that being said, all your income, all your expenses will immediately, well, if you have a separate bank account, it could go there. But at the end of the day, whatever is the income of the business, it will all go to you. All right. But of course, there's a requirement before you get all the income of your business as a disregarded entity or as a sole proprietor, you have to ensure that you have to pay the corresponding self-employment tax, which is around 15.3%. On the other hand, of course, we probably could have heard about S-Corp, and there are instances wherein they will give some people would give advice that um you S-Corp will kind of give more advantage, and I'll show you later how it was being computed, um how it will benefit you more. For S-Corp, if you elected to your business to be an S-Corp, of course, when you initially go to the IRS to register your business and you really would like to be an S corp instead of a disregarded entity, then you have to make an election, meaning you have to submit a form 2553. So from your being a disregarded entity, it will now become an S corp. So going back, if you're an S corp, top of mind, you have to remember there is a requirement for you to also pay yourself. IRS labeled it as a reasonable compensation. So what's a reasonable compensation? There's really no very strict quantifying numbers how you'll get that one. However, it says that you have to at least be at par with the industry. So if you're a consultant in your business, then you have to see what's the salary bracket of the consultants in your area. You should not go below the what's in the industry, because at the end of the day, when IRS audit your tax form 1120S, and they found that you had I would say minimize your salary there, or the reasonable your compensation, which IRS may not find reasonable, then it could lead to some penalties, or some sort of penalties. Yes. um Now, on my screen, if you will notice here, if on the right side, you'll notice here that the net income that I have computed does not is higher than the net income on the left side. Why? Because that on the right side, this is the net income that we'll use, the profit and loss statement that we'll use for the disregarded entity. We have carved out the side on the payroll side, and even the payroll taxes expense. Why? So because at the end of the day, we have to compute for the self-employment tax when we made the computation. On the other side here, on the left side, this is the profit and loss statement we're going to use when we create an 1120S for S corp. We need to put here the salaries. We make an assumption that the 15,000 is the reasonable compensation, and part of that we also have to couple it with the payroll taxes. So it will be half as an employer, half of that has to be shouldered by the S corp. All right. So this is how it works. Now for comparing the two tax forms, or here, as you can see, we're making some sort of tax planning. The figures that I lifted up came from this sample FS tab. So we just left those information. So if you will notice, for a disregarded entity, we ended up with a net income of 43,598. So it's just here. We just plot from sales down to expenses to interest income. So the net income there is 43,598. These numbers, these are the numbers that pertain to 1040. So we just put here those plot those numbers. As I mentioned earlier, we have to compute for disregarded entity. We have to compute for the self-employment tax. So if you will notice, how did I arrive at 3,080? So this is how I got the numbers. So from the net income, we have to multiply it by 92.35%. So we got this total. And then these figures, we have to compute, allocate what's for the Social Security and for the Medicare. So if you total the two, this is 5.3%. This is the total self-employment taxes. However, for purposes of the 1040, only half of this is an allowable deduction. So here we just put the 3,000 here. So the result of the net income from business, to subtract the self-employment share, would be the adjusted gross income. So this is the adjusted gross income. Now, if the taxpayer is single, she opted for the standard deduction of 13,850, and aside from that, there is a qualified business income deduction that the taxpayer can avail of. In this regard, how are we going to arrive at these numbers? These numbers can be arrived at getting the net income before of course, the self-employment tax, and then get the half of its share, and then subtract the standard deduction. This will now be the basis for the QBI, and then multiply it by 20%, and then the answer would be the allowable QBI deduction. So that's why it goes here. So if we will add the qualified business income deduction and the standard deduction, that will go into line 14. And then this one, line 14, has to be subtracted from the AGI, or the adjusted gross income. So the taxable income will be 21,334. So if we're going to use the federal tax table for this one, for a single taxpayer, will end up with a tax due of 3,440. So if we're going to do some sort of tax planning, we have to identify how much taxes were paid. All right. So this one, the assumption here is that the taxpayer is in Florida. He is based in Florida, wherein there is no state tax that's required to be paid. So essentially, the total taxes that were paid is, for self-employment tax, is 6,000. Essentially, though we only have reduced half of it, but we have to take also the full amount that was paid for SS and Medicare. So we have 6,160. We have the federal here. So the total taxes that were paid essentially is $9,600. Now that's for the disregarded entity. Now let's go to the S-CORP. For S-CORP, similarly, here in the financial, as I mentioned earlier, there is a requirement for a reasonable compensation, and then the corresponding payroll taxes needs to be paid. So in this regard, we have to impute here the salaries and the payroll taxes. So impute it in the expenses. So essentially, the total net income is 27,450. If you will notice, same figure has been used, except that for disregarded entity, I removed the salaries and payroll taxes, but for the S-CORP, I need to put it here because, of course, as I mentioned, we have to indicate the reasonable compensation. So there, we have to plot the information. Essentially, the total net income is 27,445. So it's here. All right. 445. All right. So now, in terms of K1, because the S-CORP is there's only one owner, whatever is the net income, um, the net income of the business, it will be the one that will be put into K1, all right? So the ordinary business income is 27,445, and we have an interest income, so that makes the total income as to 27,450. So it's here, okay? So for S-Corp, we also have to put there, indicate there the ordinary income, which is this one, 27,445, and how much is the allocated percentage, 20%, all right? So the S-Corp creates tax form 1120S, but this is, since this is a pass-through entity, they don't have to pay any tax to this one. All income or all losses are reported in the K1, distributed to the partners, okay? So the K1 is being given to the partners, and the partners has to put them in under Schedule E of Part 11 of their 1040. All right. So now, as we summarize the 1040 of this partner, sole owner of this S corp, this is how it looks like. So remember, for 1040, there is a line for W2. So here, the S corp has to pay this part with a reasonable compensation. So we just left it from here, the 15,000. All right. So given this 15,000, we put it there, and then add the interest income, and then the business coming from the K1 reporting, the 27,445 is here. So it ended up with this. This is the total income of the business, 42,450. For S corp, of course, there is no self-employment taxes because it's already covered in the reasonable compensation. So whatever is the total income is going to be the adjusted gross income, which is 42,450. And then this is a single taxpayer, so the standard deduction here is 13,850. And then how are we going to compute for the qualified business deduction? So this is the ordinary income presented in the as provided by S Corp, 27,445, and we have to get 20% of this one. So we just carry it forward to 1040. So it doesn't the computation of the qualified business deduction is not always straightforward, that you have to multiply it by 20%. Of course, there's a threshold, but I'm just trying to simplify the computation. Just in case the ordinary income exceeds the threshold, there is another way to compute it. Or sometimes if it really exceeds a certain amount, I forgot the exact amount, sorry about that, it will no longer, QBI is no longer allowed as an additional deduction. So in this case, you just have to add the standard deduction and the qualified business deduction, and that will be placed under line 14. So here, as you can see, the total taxable income will now become $23,111. All right. So if we're going to plot this using the federal tax table for single taxpayer, the taxpayer needs to pay $33,653 for this taxable income. And how are we going to compute for the total taxes that were paid? So let's consider here the 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 corresponding self-employment tax for the 15,000. So for the 15,000, you have to multiply this by 15.3, 15,000 times 15.8, so that's it, 225. Essentially, this is the total amount that was paid to the both to Social Security as well as to Medicare. And then for the federal, we have 3653. All right. So essentially, total taxes paid for an S corp from S corp to being that passed from S corp down to 1040, the total taxes paid were 5,942. If we're going to compare, so if you put up an S corp, you have that tax savings of 3,652. But of course, you just don't have your analysis will not stop from there, because you have to impute the following expenses, like of course, you have somebody has to prepare your tax form, so there's a tax preparation fees. And then since you're paying also the salaries, there are payroll tax fees that you have to pay. And what if that you're located in a state that needs to pay state taxes? So those are the things that we have to consider. So it's just not into this one, just a straightforward comparing the tax due. There are other considerations that you have to consider also if you will going to embrace making your business as an S-Corp. Alright, so I hope this simple case study comparing disregarded entity versus S-Corp helps. Thank you. Alright.